Hey everyone, so in this video we'll talk about what cyclicals are, and to be honest, most of the investors lose big money in these cyclical stocks because they play it on the PEs, they look at how cheap the stock is and buy them at the top. So we'll see how you can save yourself from buying at the top and also benefit from buying it at the bottom when the cycle is actually beginning. Okay. So cyclicals. So Peter Lynch defined these as what goes around comes around, right? So cyclicals have that nature in them. They go up, they go down, again they go up, right? So how to play them, that we'll see. So the rise and fall of steel, aluminum, paper, chemicals, airlines with the rise and fall of economy is a well-known pattern, right? Because as economies do well, usually the demand for all these goes up, and as the economies fall, the demand for the same things go down. So these are as reliable as the seasons. So this is a quote from his book, Beating the Street. Now we'll look at how we can identify cyclicals, how to identify whether it's a cyclical stock or a non-cyclical stock. So the charts usually tell you that. Okay, so this is Tata Steel stock from 1992 when it was listed on the NSE, but I have, for reference, I have taken it from 2000 levels where the stock went from 3 rupees to something like 60, 58, 60 in the span of those 8 years. Okay, probably from 2003, 5 years, it went up 20x, right? So let's say someone got in around these levels around 2008 at 60. So the same guy, for him to get back his money, he would have to wait at least up to 2018, or to make some profits, he would have to wait up to 2021, right? So almost a good 11 years he would have to wait in case he got trapped at the highest level in 2008, right? So here, as you can clearly see, they don't go up in a linear path. You are seeing clear cycles here where it went up 20x, then it came back to 9 rupees. So let's say I am a long-term investor in this cyclical stock, saying that Tata Steel is a extremely good stock and I want to play this, right? Then what is going to happen is, after let's say 10 years or 7 years, the stock comes back to 9 and you will be like, okay, I made 20x, I did not book, now it is back to 3x, right? So it makes a lot of sense for an retail guy to keep playing these cycles. When the cycle starts, when the cycle ends, right? So you need to time a little here in these cyclical stocks. Okay, so this is the up and down cycles, multiple cycles it had over the last decade, right? And now also there has been crazy up move, then it corrected quite a lot, almost 45% from a level of 150, it went down to 80, right? And now again it is starting a new cycle, right? So in the cyclical stocks, usually what retailers do is they end up buying it at the top, right? And then they'll say that they are long-term investors and they want to hold it for long term. To be honest, it does not make money in a long-term thing. For long terms, you would want to play the non-cyclical stocks. Okay, so this is about the Tata Steel chart. Then this is from the chart where you can identify that whether the stock is a cyclical or not, and then via operating profit method, right? So operating profit margins, these vary. So I'll tell you in the coming slides why the operating profit margin fluctuates this much in a cyclical stock. So you can clearly see in March of 2012, for that financial year, the operating profit margin were 9, and then it became 3, 11, 2, -1, 12, 17, 19, right? So 2022, it was the best, like 26%, and then 13 and 9. So the operating profit margins, they fluctuate quite a lot for these cyclical stocks. So it makes sense to kind of understand them and play them when the operating profit margin is increasing. And when it has reached its peak, it makes sense to book out, right? So this is another method. If let's say you're getting confused with the charts, what you can do is look at the operating profit method for that particular stock, and then you will be in a better position to identify whether this particular stock is a cyclical or not. Okay. Now we'll look at a non-cyclical stock, same management, Tata Consultancy Services. So this one, you would see it's a more linear chart, right? So So from the same 2008, if you look at it, it's a more linear chart, although in between it has gone down and come back up, but the fluctuations aren't really that great, right? It is kind of moving along that linear line that I've drawn, a little up, little down sometimes, depending on how the sentiment is. Okay, so this is about the non-cyclical stocks. If you look at the operating profit margins for these non-cyclical stocks, they would be kind of in that same band, probably 1-2% up down would be the range, right? So you can clearly see from 2012 itself, it has been in that 28, 29, 30 kind of percent operating profit margin. So they are very stable. Okay, you will not see huge profit jump or a profit decline in most of these non-cyclical stocks. So which are these non-cyclical? So you can take the IT sector, you can take the pharma sector, the healthcare sector, right? So those are not really affected by the economic growth or economic up or down, right? A person who's taking, let's say, some tablet for some disease that he has, he would continue to take it even if the economy is not doing that well, or if the economy is doing well, he will still continue taking it, right? So these are non-cyclical stocks where the operating profit margin usually remains stable. Okay, so these are two methods from which you can kind of understand whether it's a cyclical stock or non-cyclical stock that you're trying to buy. Okay, then now let's look at why does the operating profit margin fluctuate. So let's assume there is a steel maker who makes 1 ton of steel for $100, okay, and sells it for 110. As per current market price, he is selling it for 110. So the profit he is earning on that is $10, correct? So the operating profit margin, let's say, is 9 to 10%. Now what has happened is the steel prices have gone up. So when do steel prices go up? When there is demand for that particular commodity. So when does that happen? Generally when the economies all over the world are doing very well. So why I'm looking at the world economy here is because commodities are traded globally. If there is no very good demand for steel in India, that will not move the steel prices globally. So what one has to look for is the global prices of these commodities and then take a call. Let's assume the steel prices go up to 200, right? So from in that case, let's assume he is totally backward integrated. He has his coal mines, he has his iron ore mines. So the cost of production for him is going to remain 100. But now what has happened, because the steel prices have gone up to $200, his profits have jumped, let's say 10x, right? He's now making $100 profit per ton of steel. I'm just taking random numbers here. So what will happen is the stock should also show that it should move up like crazy. This particular thing does not happen in non-cyclical stocks. TCS can't make its profits go up like 10x in 1 or 2 years. Okay, this is only possible with cyclicals because the commodity prices move up like crazy. That is what makes the net profits also jump up 2x, 5x, 10x, right? And then once the commodity prices cool off, let's say from 200 to 150, so from the peak margins, or let's say the peak profits, the stock would again, the profits would drop 50%. So naturally the stock will also drop 50%. So it makes sense to kind of look at the commodity prices and then trade them. Okay, instead of looking at the PE valuation and then playing it, it makes a lot of sense to look at the commodity price and then take a buy or a sell call. Okay, so this is about the operating profit margin fluctuation. Then is there only one type of cyclical, that is if the economy is doing well it should go up, if the economy is not doing well it should go down? To be honest, there are two types. One is dependent on the economy, which are your metal, cement, auto. If the economy is doing well, you would see continuous demand for these and they should do well. But there are few which are independent of the economy, that is agri related stock. So these are more dependent on monsoon, right? So let's assume Brazil is the largest producer of coffee. If there is some problem in Brazil, so the last time in 2021 the frost thing happened wherein the coffee beans were spoiled, because of which the coffee prices went through the roof and all coffee stocks did really well, right? So these are independent of the economy. Let's say the global economy is not doing well, but because of bad monsoon, the El Nino effect or something like that. What has happened is the largest producer of that particular commodity, the agri commodity, is now producing 50% less. So what it would do is, because the demand remains the same, right? For example, let's say steel. When does steel demand go up? If there is a lot of activity happening in the economy, right? If someone is building house, someone is buying a car, so the demand for steel is going to go up. But let's say demand for sugar. So demand for sugar is going to remain the same irrespective of whether your economy is doing well or it is not doing well, correct? No one is going to eat more sugar because the economy is doing well, or eat less sugar because the economy is not doing well, correct? Maybe 5% up and down variation would be there. But here the supply side constraint because of bad monsoon will make the prices move up and down for these agri related. It might be sugar, coffee, rice, wheat, etc. Okay, so these are the two type of cyclical stocks that you would want to play. Now let's look at sugar stocks and how the commodity price moving up results in the stock price also moving up. So this is the sugar futures which I have taken. So after the 2020 dip, so although in sugar prices you did not see a dip. Why? Because just because there is COVID, people are not going to stop eating sugar, correct? So that is why there was no real dip even after the 2020 crash. But the stock went down because of the fear that was there in the market. After that, you would see it's a complete replica of this move that happened in the sugar prices, correct? After that, the sugar prices came down crashing. Same happened with the stocks as well. But now because of the El Nino effect and there is going to be a shortage of sugarcane production, the sugar prices have again started moving higher. Same is happening with the stocks. These stocks have also started moving higher, right? So you would want to track the commodity prices of that particular commodity, and then the companies which are making that commodity you would want to play, right? So this is how the commodity price movement would make the stock price also move. Okay, now coming to how to play them. So most of the retail investors, why they lose big money in these cyclical stocks is they kind of enter them at the wrong time looking at the P. So here I have taken one example to understand how looking at the P will not give you the exact this thing. Okay, so probably when this rally started, right, the P was somewhere around 15 or 18 for sale. So this is the sale chart that I have taken. Okay, this is the stock price of sale and this is the P chart of sale. So when this rally actually started somewhere here, right, around 40 bucks, the P at the same time was somewhere around 18. Okay, and then the stock moved higher. It went to a level of 140 plus 150. At that time, if you look at the P had dropped to like 6 or 7, right? And many retail investors, they kept on buying the stock at 3p. So in October of 21, I have highlighted it here that the P was something like 3, and looking at that, many people bought it somewhere here. So looking at the P is not the right method. Usually what happens is at the bottom, at the top of the cycle, the P's are in single digit most of the times, right? So looking at the P and buying cyclical stocks is not the right method. So what would be the right method? Looking at that commodity price. Okay, you would look at the commodity price, you would look at the demand for that. If the demand is going up or the economies are doing well, you would want to buy these economy dependent commodities. If there is some El Nino thing that is happening because of which there is less rainfall and the crop production is low, then you would want to play that particular cyclical depending on how the supply is getting affected. Okay, so hope this helps and you would not make this mistakes of entering these cyclicals at the top. Thank you.